Welcome back. You're watching Stock Picks. Today we look into Bidvest, Growthpoint and Super Group. Peter Armitage from Anchor Capital brings us analysis on those counters. Peter, a pleasure. Good afternoon.
Good afternoon.
All right, Peter, maybe before we get into the counters, is there a specific theme we're going for, a specific reason why you've chosen these counters?
Yeah, I tried to get a balance of a mix of SA Inc. type shares. I think that's really the flavor of the month at the moment, and to kind of look a bit deeper to look at how they trade, what's implied in the companies. I think they're in very different spaces, very different valuations. They're all three very different businesses, but I think there's lessons and learnings and indications of the future in all of them.
Let's start off by looking at Bidvest. That's always been, seen as SA Inc. Express, if I may. Of course, they are on a bit of an acquisition strategy now, looking outside of South Africa. But I'm just keen to get your thoughts on the counter as a whole.
Yeah, so I think first and foremost, to take a step back, when foreign fund managers come into the SA market, bearing in mind that South Africa is 3 or 4% of global emerging markets, so they don't have a huge in-depth knowledge. They tend to buy, there's a basket of 5 to 10 shares that they tend to buy. It's the ones that are liquid, that they can buy into quickly, they can sell out of quickly, and Bidvest falls into that category. And if foreign investors want some exposure to SA kind of industrial services businesses, Bidvest is the share that they buy, and it's the primary reason I highlighted it today. It's trading at close to a near all-time high, so it is being supported, but the company's done well. But an element of it which some foreign fund managers don't like, but South Africans do, and you've got to balance that, is they have now got about 25% of their business offshore. I think they've identified hygiene and services as areas that they're good at, that they can expand in globally, and they bought some very interesting businesses primarily in the UK, and they're looking to bolt on there. And that's a business kind of protocol and methodology that's worked for them very well over the years, is to have a core business and bolt on other businesses. So in SA, it's distribution and services, supports motorcar sales, hygiene, the sale of corporate type products, stationery, desks, etc. So it's freight and ports, and so widely exposed to the things that we think can improve in South Africa over the course of the next 2 or 3 years. So it is a favorite. It's highly rated. They're going to come out with results pretty quickly. This last year to June has still got quite a bit of load shedding in it. We don't expect a fantastic result. We expect earnings to grow. But if things can kick a little bit in South Africa, it's one of the companies that's broadly exposed and can get a nice positive kicker from what's happening in SA. It's not cheap. It's at about a forward 13p multiple. But if it's quite importantly, foreign fund managers haven't really come into SA. On the bond market, they've come in with about 25 billion rand since elections. Equities, they're kind of still sitting and watching. But if SA does catch a bid from them, Bidvest is, you want to own the shares that they're going to be buying. And Bidvest is slap bang in the middle of that. So it's not an absolute bargain, but I think its future could be a little better than what they were planning for a few months ago.
We have seen them announce the sale of FinGlobal as well as the bank. Keen to get your thoughts on that. Of course, it's a restructure of sorts. That financial services division actually wasn't doing too badly. I think it had finally turned a corner in the last reporting period, and it's just now that they've decided to offload it. I'm wondering if that speaks to what you're saying, that they've kind of carved out a bit of a core and then building on that core.
Yeah, they've never been great at financial services. So they haven't, their business went into losses a while back. It's quite small in their mix. I think it's less than 5% of their business. And I think they've taken a view that their business and their core business is distribution and services. And they're looking to expand that globally rather than try and put money into South African financial services, where they don't really have an edge. They don't have huge critical mass. And I think it was quite well received that they're prepared to look through their portfolio, not just be an asset manager of a whole bunch of passive assets. I think they're very involved, and I think it's kind of in line with the strategic kind of views that Bidvest has always been a company that's focused on strategy, and they've communicated quite clearly what they're trying to do. Had good people doing it, kept things quite simple, going for a high return. And I think financial services falls outside of that. So it's not a game changer, them selling it, but I think it's kind of cleaning up the portfolio.
And before we move away from this one, I'm also keen to get your thoughts here, Peter, specifically looking at that, decision to go offshore. Lots of South African businesses go offshore. They don't all succeed. Do you think, based on how well Bidvest has implemented strategy in the past, this isn't something to be concerned about where they're concerned?
Yeah, I think they've been there quite a while. Also, remember, they've got the offshore experience in what's now become Bidcorp. So the food services business was part of Bidvest, and they expanded internationally very successfully, and then spun off Bidcorp, so that's no longer part of Bidvest. But that corporate memory and experience is still there, and augurs well for them. And the services businesses they bought in the UK, they've been around for quite a few years now. So I think the strategy has been, and the one that's worked for them, is to buy something that's working with critical mass. It's not like they've gone to start something up, or often South African businesses buy things which need turning around. I think of Spar buying into Poland and now selling after 6 years not being able to turn it around. They've bought a good, solid business. They understand it well, and the strategy is to bolt businesses onto that. So, we'd be quite supportive and positive on what they can do offshore.
Then let's move over to Growthpoint, an interesting one here. Keen to get your thoughts on just a property REIT at this time, of course, Growthpoint being one of the most dominant players in the country.
Yeah, so property's been a complete mess. If you look at Redefine, got up to close to $10, it's trading at 4. Growthpoint got up to about 28 Rand, it's trading at 12 now. So it's been a very difficult space. In the office space, you've had, first of all, obviously general economic conditions quite poor. You then had retail coming in a massive pressure after COVID. But the retails, you're actually seeing rental increases in retail now. And then office has been a permanent change, where the amount of office space required has reduced because of work from home. In our offices, people are coming in 3 days out of 5, and I think that's become the norm. So less space is required. So you've seen rentals for office space come down for the last 3 or 4 years. Every year, the leases that have been renewed at kind of 15-20% down. I think that's largely reached the bottom. If your average leases are 4 or 5 years, after 4 or 5 years of that, you've kind of got office leases kind of down to the market-related level. So this is going to be another tough year for Growthpoint to June. But then going forward, we think they can get back onto, kind of a 5 to 10% growth path. So with property, you've got to, you look at your starting point. Your starting point is a dividend yield of about 10.5%, which is quite healthy. Now, remember, the property companies always used to pay out 100% of their earnings. So the dividend yield was the same as the bottom line yield. So Growthpoint now, they're probably going to pay out about 85% of their earnings. So the distribution yield, which is like on all the earnings, is 12.5%. But the actual dividend yield, because they're keeping a bit of the cash in the business, is about 10.5%. So that 10, you can earn 9.5% in our money market fund. So 10.5 gives you a premium, so it's a nice starting point. And then it's attractive if it can grow. If you can have 10.5% growing at 10% a year, so you get 10.5% this year, 11% next year, 12.5% the following year. Very simplistic maths. That becomes quite an attractive investment, particularly if interest rates are coming down and the South African economic outlook is a little better. So we've got a price target for Growthpoint of about 14.50 Rand. It's trading at 12 Rand. So, this is not these property shares, you don't buy them for them to double unless they've really been tanked. The space that they're in now is you've had some recovery, but there's a very solid, we think the property fundamentals, not fantastic, but they've improved and they're on the up now. So it's a good starting yield and a good way to play. Interest rates are at 15-year highs. So property companies, interest rates are relevant for 2 reasons. One, they all have debt, so their interest costs will start going down. And secondly, if bond yields come down and the cost of money in South Africa for the government comes down, typically the valuation of property assets goes up as well. So we think there's a nice combination of positive factors, which in a base case can give you 10-12% return over the next year. And if things go really well, you could get a 25% return. So it's not a big punt. But for somebody who's looking for a fairly secure return with some nice potential upside, we think Growthpoint fits in there quite nicely. They've also got about 30% of their assets in Australia, which is similar to the other one we'll talk about, Super Group. Those businesses are doing fairly well. So you've got a bit of a mix. And the star in their portfolio has been the V&A waterfront. As tourism has come back, the profits from that business have gone up dramatically.
I want to ask you just about the office as a whole, I guess, looking at the property market here. Of course, like you say, the way in which we work has just changed, and I think it's changed for good. What do we do with the oversupply? I think we always speak about Gauteng, specifically Sandton, specifically also just an oversupply of these offices in an economy that's not growing. It's just vacant, really, lying there. And it might be too expensive or not even necessary to repurpose, Peter. And I'm wondering what the future might look like from your perspective.
Yeah, so I think that's the fact. That's factored into the share price and factored into the dividend yield that I'm talking about. So you obviously the stuff that's vacant, you're not getting a dividend from, and that's not part of what you're paying for in the price. So if anything, there's a little bit upside there. And what's happening is, people what the really tough space is the B and C grade property. Because there's empty A-grade space, which you can now rent at a pretty reasonable rate. So some of the C-grade stuff, the kind of older offices sitting in Bryanston, which need to be refurbed, they can't let that out for 60 Rand a square meter.
Sure.
So it's about 25%. It's about a quarter of Growthpoint's portfolio, but I think that's bottomed, and there is potential for some reversioning. I think at a stage, I don't know what the latest number is, but after COVID, there was about 400,000 square meters of vacant office space in Sandton. So some of that's been filled up, some of it will be reversioned, but it's a permanent change, and it'll take many years to sort out, because obviously new property developments are not viable because you can rent current properties at such attractive prices. So slowly that'll fill up, and business and offices will have other uses. But that's really been where all the pain is felt, and there's been some permanent reduction in value. And that's part of why, a Growthpoint, which was well into the 20s a few years ago, you can now buy it at 12 Rand. And that's a reflection of that permanent decrease in value being factored in.
Brilliant. Let's go into Super Group now. That's another interesting one, plays in a space that I think is fleet management. It's quite a bit of vehicle sales there, quite just mobility as a whole.
Yeah, so Super Group's an interesting one. So the reason we chose it, so Bidvest is in that big company category, and trading at a fairly healthy multiple, about 13. So people have been fairly positive. Some of the positivity about the change in direction in South Africa has been felt there. Super Group sits in that kind of mid-cap category where there's a whole bunch of pretty good quality companies. It's not a superb quality company measured by kind of fund manager basics. It's quite asset heavy, etc. But it's a lot of its cash flows go back into equipment. But it's a very good, solid business. It's been very well run by Peter Mountford for many years. And these companies are trading in the 6-7p multiple, forward multiple category. So these things are really cheap. And it's the kind of share, the share price is sitting at 30 Rand. If it was 40 Rand, you'd be looking at it and going, okay, that's sort of well priced, still got some upside. So the trading, the really poor SA valuations, which people have been banging the table on, is still reflected in something like a Super Group. Now, in this company, you've also got quite an interesting kind of mathematical equation for us analysts to do the numbers in a spreadsheet, where they own 60% of SG Fleet, which is a fleet business in Australia, which is doing very well. Its share price has gone up 30-40% this year. And so Super Group's market cap is 10 billion Rand. That's its value on the market. And the value of its stake in the Australian SG Fleet business is 7 billion Rand. So the kind of implied value on the SA business
3 billion.
is 3 billion rand, and that represents a kind of 3 or 4 P multiple. So there's quite a bit of underlying value. If South Africa is not going to be great, you're hugely protected by the fact that so you've got about 21 rand per share in value for the Australian business. So bizarrely, in their last results, they've got businesses in South Africa, Australia, UK, and Germany, and it was the South African businesses that did fairly well, and it was the UK and European businesses that let them down from a growth point of view. And those are still under quite some pressure, as there is a lot of economic pressure in the UK and Europe. So they've diversified outside of South Africa, but it's the non-South African businesses that have been tripping them up a bit. In South Africa, it's fleet maintenance, automotive sales, distribution. All of your convenience shops at the garages and the like. Super Group is stocking them up, and they've got quite advanced distribution and logistics capabilities. So again, it's kind of it's SA businesses in the heart of SA industry. It's then got some, and you would think the UK and European businesses can come back. And if you were to do a rational sum of the parts valuation of Super Group, you'd probably come to around 45 rand a share, without being too bullish. And it's trading at 30. So the risk with these things is these mid-cap shares, the story's been the same for the last year, and they haven't really gone anywhere, and our portfolios are not full of them. But we're looking at them very closely, and if the SA market continues to get the kind of support that it's got over the last month or two, I think they will follow. They'll kind of get dragged up from their low valuations.
Peter, I must also ask you, just curious there a little bit about Australia as a territory there. It's one that South African companies also quite like. I'm wondering if there's similarities there, if there is a reason why we look in that direction. It could be that there's so many South Africans in Australia that it feels like home a little bit. I'm just keen to get your thoughts on that, curious about that place.
Yeah, I think part of the reason we've gone to Australia is familiarity with South Africa. The economy's, it's a commodity based. You can draw a lot of comparisons. The sun's always shining. There's a lot of South Africans there. It's a tough place to do business. A lot of South Africans have gone there and really failed. When Australian corporate financiers come and offer a business for sale to South Africans, it's because no Australian wants to buy it. Property is very expensive. It's a very socialist society, so it's tough. But they have a well-established. They started a business there. Larry Lipschitz was very entrepreneurial, and got that started. And it's been a very successful, very solid business there. It's asset-based. They lease out vehicles. So the downside risk is quite low. And you many years past that kind of starry eyes in Australia, send the B team there and come back with your tail between your legs. That it's a good business. It's been quite highly rated by the Australian stock market. But as a default, you've seen a lot of South Africans cruise over to Australia and get burnt and come back and realize that SA ain't so bad.
Well, Peter, all we have time for today. Always great hearing from you. Thank you so much for taking us through today's stock picks. That was Anchor Capital's Peter Armitage.